Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. So this morning we got the Federal Reserve's favorite measure of inflation, the Personal Consumption Expenditures Index, or PCE for short. And inflation continues to go higher. It's moving away from their target. The Fed's target is 2%, and we're getting a lot closer to 3%. We're almost essentially at 3%. So inflation continues to go in the wrong direction as it relates to the Federal Reserve. And as the president's tariffs work their way through the system, I think the inflation number will continue to go higher. The big debate on Wall Street and everywhere else is this a one-time move higher in inflation and then it stays where it is, or is the inflation number become more persistent? That is the big looming question out there that nobody really has the answer to. We're going to have to sort of wait and see. But it's clear that the inflation data we continue to get, inflation is moving in the wrong direction, and we do know that Americans hate inflation more almost than anything else, and so it'll be very interesting to see how this plays out. In a couple of weeks we get the Federal Reserve's policy rate setting meeting in September, where I think unanimously people think the Fed's going to cut. I mean, we do get one more labor report to see how the labor market's doing. The challenge in the labor market is that we could see, because of the immigration situation in this country, a lot of people are leaving the workforce to leave the country, and so unemployment could go down, but we could see almost no job growth in this country, which would be a weird phenomenon, but it could certainly happen. And so I think one thing that is clear, the Fed's going to cut at their next meeting, but one thing that's clear is the U.S. economy is certainly slowing. All of the growth, any of the growth that we're seeing right now is really just coming from the top 7 companies here in the United States, and that's mostly all on AI spend. AI spend by these companies is now more than all of consumer spending in the U.S., which is a crazy thing to think about. And how that plays out is going to be also very interesting. It feels a lot like the late 90s when all that money was being spent on the internet and internet companies. And then we know that the outcome of that was just a few winners, and I think that's going to be true in this case as well. So it's a very interesting time for the U.S. economy and U.S. markets. U.S. markets are at extreme levels of expensive, and so that will be very interesting to see how that plays out. But our asset allocation, we really like what it looks like, and Josh can comment on that.
Finally, just a couple more points on the inflation thing. We've been arguing essentially for 5 years now that it was a structurally embedded phenomenon. A lot of it is tied to demographics, and it's consistent really across the Western developed world. And absent immigration, we think that there's probably going to be a lot more wage push inflation in the years to come, but that's going to take quite some time to materialize. So we'll definitely be watching that. But tariffs really amount to just this consumption tax, which of course is going to also drive prices higher in the near term. And depending on what you buy, you'll be more or less impacted by that consumption tax. But it's less inflationary on the services front. But services inflation is really embedded, and it's simply because of this demographic transition and really a lack of skilled labor out there performing the services that people need, and in the restaurant business, etc. If you're out there going out to eat or traveling, you're certainly exposed to it. But when we look at what's happening, if they cut rates on the front end, we try to game this out in the office, and the Federal Reserve follows through in September, that's probably going to lead to additional asset price inflation, which is then going to be more stimulative via the wealth effect. So it's hard not to see longer end bonds yields moving higher, which would of course increase borrowing costs for the federal government, and then actually fuel higher 30-year mortgage rates because they're built off that long end of bond yields, and that certainly wouldn't be a positive for people that aren't on the housing ladder. Even absent long end bond yields moving higher, we think the dollar is probably likely going to continue to weaken, which should be a huge positive for international stocks, but it's also going to be positive for those big multinational businesses that seem to be in that heads they win, tails you lose type scenario, where a cheaper dollar is going to be stimulative for the services that they're selling abroad. And so we feel really positive overall about our asset allocation, namely owning the Mag 7, which is going to win no matter what, and also a healthy exposure to international stocks.
Yeah, I mean, our international exposure is a lot higher than most of our peers, and that's certainly worked out on a year-to-date basis with dramatic outperformance. But the president is going to have a new Federal Reserve chairman, and the president really wants somebody in there that's going to cut rates aggressively, which means that's going to be bad for the dollar and great for international stocks. So we really like our international allocation. All right, if you have questions about your situation or your account, give us a call at the office, 800-743-0988, or you can email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We hope everybody has a great Labor Day weekend, and we'll see you back in 2 weeks.